Welcome. You're listening to The Best of Investing. I'm your host, Edward Brown, along with my co-host, Mark Hanf of Pacific Private Money. Our phone number is 888-912-1190. Use that number to answer the trivia questions for a 5-pack tanning certificate given away during this show. And that certificate is not sponsored by the radio station, but by Tambella Tanning Salon with 2 locations in San Francisco and 1 in Marin. And today's trivia theme is entertainment. Today's special guest are very good friend, financial advisor, and best-selling author, Ken Winans, who is part of the original Best of Investing group, going all the way back to August of 2010. Ken,
oh goodness!
What?
Oh my gosh!
Believe it? We're all
old.
A little older now. Yeah. Some of us have gray hair, and some of us have more gray hair.
A little older, a little wiser, hopefully a little wealthier.
Yeah,
12 years later.
So Ken, you are like the financial guru, and you and I were talking ahead of time before we got on the show about inflation. What should people do? Where do you think things are going? Take it away.
Well, I mean, I'll tell you, I always get in trouble because I'm not the most politically correct person on planet Earth. But I one time, just not long ago, told somebody we are decided to redo the Jimmy Carter playbook on inflation. And the only difference now than the 1970s is that we don't have the fun fashions and we certainly don't have the good dance halls anymore. So we get none of the fun of the 70s and all the crap that goes with it. But no, you know what? I'm just going to say, Edward, just to toot my own horn, I mean, I've written 4 books. I write for Forbes. I do ABC radio every week. My books have won a lot of awards, knock on wood, that's great. But I am a financial historian, and I really do believe in putting history in the driver's seat. And it is eerie how that there are times when it's never the same, but it certainly has a rhythm and a rhyme to it. And we have that going on right now.
Well, hold on. Interest rates, though, are not quite at 20.75% yet.
Not yet.
Not yet. Okay.
Not yet. No, that was, and if you remember, my friend, that was the end of the 70s.
Yes.
In the early part of the 70s, the Fed did the same thing they did now. They were too late. They wanted to keep the economy. So let's go back, unfortunately, in a not real fun memory lane.
Yeah.
So back in the 70s, we came off of a losing war. Back then it was Vietnam. We came out of a political scandal. Back then it was called Watergate. This is beginning to sound familiar. The Federal Reserve coming out of Vietnam, lots of debt. They said, look, we need to keep the economy going. We don't want a post-war recession. There was volatility in the markets. There was a pretty nasty bear market in 73, 74. Yep. The other thing that was interesting is that there was a change in the dynamic of currencies back then called the gold standard, yep, which we immediately went off. And now today people are talking about crypto possibly being a rival to the dollar. So the same kind of flavors are all out there. But the other thing that we have spent way too much time focusing on the pandemic, and especially people like to compare it to what happened with the Spanish flu 100 years ago and all that.
Yeah.
I think they're missing the whole mark. They should be looking at the last time the world economy was truly jolted economically, purely economically, was the Arab oil embargoes of the 70s.
Yeah.
Instantaneously, overnight, oil quadrupled in price. Instantaneously. It seized up everything around the world. Does this not sound familiar? Then it happened in waves. There was one embargo. Then there was another embargo. Okay, we've had COVID variant 1, Delta, Omicron, wave after wave after wave. Just when you think it's over, boom, you get hit again. Social disruptions. I know people want to think that, what's going on today with a lot of the frictions in our country. No, back then you had racial issues then. Obviously there was a lot of structural changes in the American social structure. I mean, you can go back and think of the Black Panthers, Hugo Chavez, gay rights, women's rights. You had kidnappings, if anybody remembers the Patty Hearst mess, all that. I mean, you can just find these eerie similarities. And so going forward, let's get back to why I think this is important. So the Federal Reserve, back when in the 70s, did the same thing that this Federal Reserve did. It leaned towards keeping the economy going, keep too much money in the system for too long, and that we can somehow control this. Does this not sound familiar? Okay, I believe the Federal Reserve realizes they've went too far too long. that they've done too much money into the system. It has caused, like, whether we're talking about real estate, stocks, bonds, commodities, you name it. And by the way, this is a global phenomenon. You now have bubbles or record valuations on everything. Everything's high.
Yep.
And so then you have inflation, as we all see in the statistics, whether you're looking at consumer price index, producer price indexes. I love how they keep saying, oh, we're setting records we have not seen since the early 80s. Oh, gee, what a surprise.
Yeah.
But the problem we have is kind of where we are, or the Federal Reserve is still not, I don't think, taking it real serious. When they start talking about these quarter point increases gradually through the year, I'm willing to bet, I really hope I'm wrong about this. I don't wish this. But I think as the inflation numbers accelerate, and especially as there's blowback politically, I mean, especially we're in a midterm cycle for the Congress. If there is enough pressure coming from the political group on the Federal Reserve to say, you know what, you guys better really start doing something. This is now causing us problems. And then I'm not even going to get into the budgetary mess at the government level with, $34 trillion of debt that they need to refinance in this environment. But my point in all this being said, guys, is simply that the inflation thing is going to be with us. It's not going to end soon. I think we've got another 5 years of this. And unfortunately, as you both experienced it and as I did, the medicine for dealing with this is going to be shrinking the money supply, i.e. shrinking the availability of credit.
Yeah. We'll continue on. We have to get to a quick break here. All right. Sorry about that, Ken.
Oh, no.
I know me,
I can talk forever.
Good. Okay. Here's our first trivia question. When Forrest Gump was in the Army, what sport was he good at? Call 888-912-1190. First caller with the correct answer is going to win that tanning certificate. Don't touch that dial. The best of investing. We'll be right back.
Let's let you kind of go back and wrap up again.
Okay. All right. Hey, welcome back to the best of investing. Edward Brown, Mark Hanf, and Ken Winans here. First trivia question. When Forrest Gump was in the Army, what sport was he good at? You guys remember?
Oh, yeah.
Yep.
Go ahead.
Table tennis.
That's
right.
right.
Or ping pong, whatever you want to call it.
Yeah. Exactly. All right, Ken, go ahead and continue on. Sorry to interrupt.
Well, unfortunately, as history has shown with inflation, one of two scenarios come out of this thing. Either the economy really accelerates like it did after World War II when it took off. I mean, but then, and by the way, I'll come back to that in a moment because that deals with supply chain disruptions.
Yeah.
Or you have what happened here where, right now, I mean, you guys know, when was the last time you heard the term stagflation?
70s.
Yeah.
79.
I mean, here we go. It's all back in the news again. Even that beloved economist Paul Krugman was bringing it up the other day. The point is, the Fed has really gotten itself in a box now where if the economy slows down and the inflation does not, which we know that they can move independent of each other, you can have rising prices and have a slow economy. They're going to have no choice but to do what Paul Volcker did, which is dry up the money supply, which means less credit for companies, individuals, mortgages. Rates are going to have to go up.
And I know print more money.
Huh?
Just print more money.
Can't do it anymore, man. They can't. Are you kidding? And that's the only. And I get asked a lot by people, what keeps me up at night?
There you go.
A correction in the stock market. I mean, look, a correction in housing. Look, we've all done well. I mean, however we may vote, it doesn't matter. If you've been a reasonably sound investor, you've made money in the last 10 years.
Yeah.
Okay, you did. So to give back some of that, we don't like to do it, but hey, you have to. What keeps me up at night, though, is that I'm concerned about the banks. And what I worry about is if the banks decide, and I'm reading this a lot in their language in their annual reports, and they're not planning on rapid expansion of their loan portfolios. They are, and remember, they're always worried about the demon of the past, once bitten, twice shy.
Yeah.
They realized what happened in 2008. They do not want to be villainized again. I mean, they've spent over a decade being crucified by every politician that they were the cause for 2008, even though we can argue the government had an awful lot to do with that insanity back then.
They were, yeah.
But I'm concerned that the banks might start saying, you know what? we don't trust Fannie and Freddie. They had to be bailed out before. They're gonna, or I don't trust the student loan backstop is in place, or I don't trust there's anything about. We are going to unilaterally start tightening credit. We're going to raise our lending standards. So and the Fed might say, what are you doing? We're trying to help you. And they're going, we're not playing this game again. We're not going to be left holding the bag. We're going to start to be very judicious on who and how we lend money. And then if you throw into the mix social agendas, who's getting what money and why, all the more reason for them to say, we're just going to collapse the whole thing. If you're not going to let us use lending standards regardless of social metrics, then we're going to have no choice but to.
Well,
so
they did for Dodd-Frank, they did tighten some regulations where you have to have ability to repay. So they definitely did, some of that. They loosened up some stuff, but not, that has to do with the small borrowers.
It's not the reality of. I mean, there were some things in Dodd-Frank, and you're right, Edward. There were some fixes, but I'm just saying that if you're a banker, you're looking at high inflation. You realize that banks they usually get squeezed initially in an inflation cycle because they have a tough time raising rates to keep up with the cost of money. Blah 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 blah. I'm just saying that there's enough of them there that I'm concerned. They say we just need to be smart. We need to protect ourselves here. Yeah. And we're going to start unilaterally get ahead of the curve on lending standards.
Now, could the government force the banks a certain direction? I mean, they can play around with the Fed Reserve rate, because I remember when I had a friend, kind of a relative, very high up at one of the very, very large banks. And he was sitting with a very well-known San Francisco politician, just trying to avoid all the names here. And during this debacle, the politician leaned over and talked to the CEO and said, "Oh, by the way, we're going to be, we're going to be lending you money, and we're going to participate with you, blah blah blah." And the CEO said, "No, that's fine. Listen, you know what? Our bank is not in trouble at all. You don't have to worry about us." And she leaned over and said, "No, you don't understand. We will be lending you money. We will be participating with you." And so my point is, what point does the government force themselves onto the banks?
Well, I mean, they can. Well, I mean, a lot of their forcing is on affirmative action type stuff. I mean, for lack of a better term, economic redevelopment zones and stuff like that. But I mean, I don't think a government can order a bank to lend money. They just, and also this Fed, they've already put enough money out there. They can't just suddenly loosen everything up. I mean, again, I hope I'm wrong on this. I don't want to go back to this, but there is that possibility of banks which literally is what they did. And I hate to bring up the comparison, the Great Depression. Yeah. But more important than that, they know what inflation looks like. They need to maintain their spreads. And I just think at some point they're going to say, look, we'll lend you money, but it's going to cost you a lot more. Yeah. And if you go back and remember the late 70s, people had 15 and 16% mortgages, and they were happy to have them because they got a loan. Many times you couldn't get a loan. So, guys, I really hope I'm wrong about this, but let me switch gears here, Rick. Let's talk about the financial markets.
Yeah. We have all this 4 seconds, but we have to go to our next break. Go ahead.
All right, I'm just going to say, let's talk about bull, bear, or the more likely scenario, a long-running sideways channel market. Okay. And what's going to happen there? So, do you want me to keep going on, or?
Yeah, actually, let me go ahead and cut to this break. All right. Next trivia question number 2. What sport is the focus of the movie The Color of Money? All right, 888-912-1190. First caller with the correct answer is going to win the tanning certificate. I want to make a quick mention here also for Palio Restaurant, premier Italian restaurant serving downtown San Francisco since 1990. It's no surprise they've been voted best Italian restaurant in the SF Weekly this year. Palio has consistently been voted one of the best restaurants in San Francisco by San Francisco locals. Visit paliosf.com. That's PALIOSF.com and review their menus and make a reservation today. All right, stay with us. You're listening to The Best of Investing. Don't touch that dial. We're going to be right back. Welcome back to the Best of Investing one more time. I'm Edward Brown, your host, along with Mark Hoff of Pacific Private Money and Ken Winans, our special guest. Second trivia question, what sport is the focus of the movie The Color of Money?
Was that pool?
Pool, very good. Mark.
Billiards.
Two. Billiards, yes.
And actually 9-ball.
9-ball.
Nine
Yes,
ball.
that's right. Exactly.
Yep.
Love that. Okay. Ken, continue on. You're
Well,
talking about-
and it's kind of funny because, again, the question that I think most people really care about, we can have this ongoing discussion about, the general cost of living. Again, I bring up to everybody, whatever you're buying today, you name it, food, cars, whatever, it will be 20% higher in 4 years. That's just it.
Yeah.
Okay, that's it. That's inflation. It's across the board. That's where people worry about what their money's worth. But so people then turn to their portfolios and they say, well, what I've been able to do over the last 20 years is take money out of my portfolio to go subsidize my lifestyle, whether they gutted the equity out of their houses, as we saw them do, before 2007 and 8, and they've been doing recently. But here's the problem. The markets will not give you the kind of returns in real terms in a high inflation environment to be able to continue doing that. You'll be net taking your net worth out. So I think that where it's a bull market, a bear market, the real situation probably will be a sideways moving stock market where there are defined ups and downs, but there's not really much in the way of real momentum to the upside. I see that, and it's, by the way, a buy and hold strategy with index funds will not work in that environment. Go back and look at what happened in the 1970s. The Dow started and ended that decade up 2%.
Yeah.
The whole decade. And after inflation, it was a train wreck. If you go back and look at other inflationary periods in the U.S. economy that maybe didn't run quite as long, same effect. Equity markets are subdued. Now, the bond market, again, and it's kind of interesting because you have a lot of people looking at retirement and they don't want to take risk of owning things. They want to have an income.
Yeah.
Well, they've been, what's standard financial planning 101? Well, people migrate their portfolios out of stocks and real estate into bonds. Well, guess what's going to happen? If you go into long-term bonds, what you're going to notice is that all bonds come due at 1,000, but if you bought that bond above 1,000 at any point in time, you're going to probably see the price go down quite a bit because as rates go up, bond prices go down, and depending on how fast these rate increases are and the general level of interest rates in the market, you'll find that bonds where people have been used to getting 6% yields, but their bond fund has been paying them 7% a year. I argue you're still going to get that 6% or maybe higher, but your total return at the end of the year is going to be more like 4 or 3 because the bonds in the portfolio took a hit on a year-to-year basis. So you're not going to get any freebies there. And so then you go into, well, where do you make your money in real estate? Well, make your money in inflation. Well, real estate's one area, at least initially until rates go up too much where prices get soft. But the other area, commodities. And most people in this audience probably know about commodities, but never really thought about them putting them in a portfolio. If you go back and look at what happened in the 70s, the people who had money in corn, cocoa, soybeans, oil, gold, you made big money. So if people are looking at where should they begin to at least consider whether it's in an ETF form or hiring a commodity trading advisor, I think you have to seriously think about reallocating toward more of that.
Interesting.
Can we shift over to real estate? Because I want to talk to, I want to have Mark chime in on this.
Sure,
Well, although let's just, before we do that, any comments on what's happening this week in the market? Facebook famously took a big bath this week in tech in general, and January was a very, very unusual January. We haven't seen one like that in a while. What are your thoughts on what the market is, how it's behaving in real time right now?
There's an old saying, and I actually agree with it. As January goes, so goes the year. It doesn't mean that it's going to be an absolute, 2008 all over again. But what I can prove, Mark, is if I go back and look at real estate, my data goes back to 1936. I can show that with the headwinds that generally hit that cause a negative January, those headwinds go through the year. And if you have a positive year, it's very subdued, single digits type stuff. but you can have as much as 19% drawdowns during the year. So it's not usually a great year. And by the way, let's talk about that real quick. Why January? Well, there's a lot of data that hits. You have the Federal Reserve come out and make their announcements as they've done here recently. The Treasury Department comes out and talks about their borrowing needs for the year.
Mhm.
You usually have a presidential State of the Union address that tells you what the administration's agenda is for the year. And last but not least, most companies report year-end results and guidance for this year.
Yeah.
So as you talked about with Facebook, clearly between what they produced for the year and their guidance for this year, it paid a price. It was down 25% today. So that is not a positive environment to expect a continuation of a bull market through this year.
Yeah.
So it's just not.
Gotcha.
But I will say, so you want to talk about real estate. What I will tell you very clearly that are positives right now in the market, and I'll just write a couple of names. Public Storage, the storage company, that if you had to buy one stock, that, and just, even though I don't like to buy and hold and turn my back on things, this company has got the perfect business model. Everybody has hired them at some point in time to go put their crap somewhere else but in their house.
Right.
Okay, but last but not least, anything that is in the apartment building REIT space. And the one that I'll talk about is Avalon Bay. Stock's doing great. Their REIT payoff is secure. They have complete dominance on being able to control rents and how much they charge. And it's the buyer, it's the renter is not in a dominant place right now. Apartments are full, and these guys can raise rents at will. So that's where I see it.
All right. When we come back, Mark Hanf will share with us a little bit on the real estate side. Also, we have a question for him about how are foreclosures handled, if any, on a loan in any of your funds. All right. Here's our third trivia question.
Hey guys, I'll be right back.
Okay.
Right back.
All right. Here's our third trivia question. What movie did the villain Hans Gruber appear in? All right. Call 888-912-11. Yeah, all right. 888-912-1190. First caller with correct answer is going to win that tanning certificate. All right, stay with us. You're listening to The Best of Investing. Don't go anywhere. We are going to be right back. Welcome back to The Best of Investing. Edward Brown, Mark Hanf, and Ken Winans here. Third trivia question. What movie did the villain Hans Gruber appear in? Mark.
Die Hard.
Die Hard. Oh, 3 for 3. You're awesome. All right. So, Mark, before we get into our email question that came in for you, tell us how are you doing there at Pacific Private Money?
Well, demand for alternative real estate finance is just bonkers. It's on fire. So, we talked to the first half of the show with Ken, about trepidation in the overall economy, the markets, interest rates, inflation. We feel like we're at a watershed event there. Real estate, on the other hand, while it's certainly not immune to the rest of the economy, we certainly don't have a market that resembles what was going on in 2005, 6, and 7 that resulted ultimately in the Great Recession, a 3-year deflationary period that really took the wind out of real estate. I mean, we've got a situation now where you've got a strong lack of supply, not only just in California, which we've been almost grown accustomed to, short supply, low inventories, and multiple bids, and cash buyers winning the day, all that stuff. Now that's happening more and more in major metros throughout the United States. We had another year, 2021 ended with double-digit nationwide average increase in home prices. It's the first time it's ever done that. California, of course, we've seen that for decades, double-digit real estate inflation, but not so much the rest of the world. So all of that happening, you've got strong demand for buying mostly single-family residential and multifamily. So you've got SFRs, and then multifamily is on fire. Commercial, not so much right now. It's still feeling the effects of COVID. Office space is difficult right now. Retail is difficult. Industrial has done very, very well. But just in the macro, we've seen our business origination volume last year was up 80% over 2020. And we think we may actually double it in 2021. Not because one specific loan product is in higher demand than others, but we've actually expanded our loan products just to kind of react to the demand we're seeing. And we're seeing a lot of demand still for our consumer bridge loan product that helps people buy their next home before they sell their existing home. We're seeing strong demand in multifamily, both construction as well as acquisition. We're going to close, if all goes well, tomorrow, our first $40 million loan on a multifamily home in a multifamily property in Brooklyn, New York.
Wow.
So we've expanded our reach. We're now lending in most states where we see something that we think is a good fit for us. So between residential and multifamily, that's our loan demand is growing quite a bit. And so, but in terms of like for investing in real estate, it's certainly difficult right now to predict, how much more wind is in the sails for, let's say, single family home appreciation. But, I've been in the real estate industry for 40 years. And as long as I can remember, well, and I've been exposed to real estate since I've been a teenager. So you could almost say over 50 years. My dad was a builder and a developer. The best time to buy real estate is yesterday, right? It always seems to be a good time. Now, of course, if you bought a lot of real estate in 2008, you had to wait a little while, right? Or I should say 2006, 7, when it was really at its heyday, you had to wait 3, 4, 5 years for that price to come back, but it did. And now if you've held those properties, if you're fortunate enough to be able to hold the properties you bought, let's say at the height of the market before the last recession, well, you've seen those prices go up yet another 50% from what you paid for them in 2006. So just in general, the demand for capital is strong. Inventory is low. We're helping people compete with cash buyers through our short-term bridge loans that are like cash. Most of the pundits and posts that I follow online suggest that 2022 for residential real estate is likely to be another strong year. Not sure if it's going to be double digit. In fact, I personally wouldn't mind it if it was 6% versus 16% year over year. I think that's more sustainable. But after that, I guess it's anybody's bet because, as Ken alluded to earlier, if we're going to see stubborn inflation, 10-year yields that get driven north, mortgage rates that spike up to rates not seen in 10 years, it's hard to know what might trigger the real estate market to change from what's been a seller's market for, it seems like forever, at least the last 10 years, into a buyer's market. What's going to cause real estate prices to soften? If it's just a matter of supply and demand, that's certainly not going to impact real estate in a negative way. But you can't, if the cost of money goes up significantly, your dollar is going to buy fewer dollars of real estate. So it's just the math just doesn't work for long-term appreciation the way we've seen it in the last 5 years.
Okay, so let me ask you, because we did get this email question. So how are foreclosures handled, if you have any, on a loan in any of your funds?
Well, what's interesting is the foreclosure law has actually changed in California a little bit. Now we've done, and they changed actually in 2021. So we've been a year into this slight change in the way home foreclosures happen in California. So we foreclosed on, I want to say, 5 single-family residential properties in the last 12 months. And in each of those cases, the foreclosure, the auction, nobody bid on the properties, so we ended up owning them. Now, on several of those, we fixed them up and sold them at a profit. But with the new law now, after the auction date, there's 45 days where a qualified buyer can buy that home from the trustee for the auction state. So there's been a lot of there's been an interesting change in the way real estate investors have approached the market, where they're setting up nonprofits and other types of entities that can put up qualified buyers to buy foreclosed properties from banks. I think that's a good thing. It just it gives it's another opportunity to buy.
But what ends up happening though is that the borrower gets messed up basically, because all that happens is nobody who's going to outbid at the sale, and the excess proceeds go to the borrower, because
Well,
they're going to say, what's that?
The excess proceeds do go to the borrower.
No, I know, but that's right. And nobody would do that, because a qualified buyer could come in within 45 days and pay just whatever the price that the lender had. So the borrower actually is going to get, we won't use any derogatory terms, but we'll just say messed up.
Yeah.
On that.
Bottom line, though, foreclosures have not been an issue for most lenders. We still are I think, a ways away from anything that might even closely resemble what was happening in 2008, 9, and 10, where foreclosures were pretty rampant.
All right.
Absolutely. Let me just jump in on that.
We're going to cut to our break. No trivia question. When we come back, go ahead and make a comment on that. All right. Stay with us. You're listening to the Best of Investing. Don't touch that dial. We will be back with some closing comments. Welcome back to the Best of Investing. Last time for today, I'm Edward Brown, your host, along with my co-host, Mark Hanf of Pacific Private Money, and our special guest, Ken Winans. Ken, you wanted to tag along on the real estate. Go ahead.
Absolutely. Well, just that everybody should remember, when we talk about real estate, remember it is a basket of commodities. I mean, it's copper, cement, roof tiles, lumber, all that stuff. And so as commodity prices go up, you should expect your house, because the replacement costs have gone up, that it will rise as well. So, but again, like you said, like Mark talks about single-digit results for this year, that could just be the housing market itself not going up, but inflation's making the price go up. But Mark, I was also going to throw out, I think that what you do, you're a litmus test on that. Like we hear about this mass migration out of California, or this mass migration out of cities into places like Marin County, Sonoma County. And I think that, like you're hearing about people needing that, look, I can't sell that place in San Francisco, but I need a loan right now to go buy my place in Novato. I think you guys are on the front lines of that. Are you still seeing that migration?
Yes, we're still seeing strong demand for moving out of cities into suburbs. The biggest challenge is just, in California, in the metros where people, or suburbs rather, where people want to move, the supply has just been ridiculous. And of course, right now, we just got through December and January, the two lowest inventory months of the year. So we got the Super Bowl coming up. That's the traditional start of the housing season. So none of us, none of us have perfect crystal balls, but we have reason to believe that more people will come out and begin putting their homes on the market. And one of the ways that we help actually create inventory in the marketplace, and this is something we have to educate real estate agents about, is if you use our consumer bridge loan as a tool, you can actually find people who want to move but think they're stuck because they've been told by their mortgage broker or bank, you don't qualify to have two mortgages at the same time. You have to sell your existing home first, and then you can go out and buy your next home, and we'll provide you the financing.
But they're nervous about that because they're scared that they sell, and then where are they going to move to? Where are they going to find it?
So we're busy promoting to as many realtors who will listen, whose attention we can gain, and say, look, guys, the boomers are being blamed right now for some of the inventory shortages because they're refusing to move. There was an article a year ago in the Wall Street Journal that said we've gone from 7 to 13 years in terms of staying inside a home, and it's mostly the boomer generation. Well, how many of those boomers would move if they knew they had a tool? And you need to show them that they can move right into their next home. We'll provide 100% target financing on the purchase of their next home and cross it with the equity in their existing home. And most of our clients, the vast majority, over 90%, actually make more money selling their departing residence vacant and freshened up and staged, and it pays for our bridge loan. So our financing ends up being free to them. We make money, the realtor makes money, the homeowner gets to move right into their next home, and they're money ahead at the end of the day. It's an absolute win-win. It's so.
You know what, Mark, give out your information, and then Ken, give out your information.
Sure, pacificprivatemoney.com, pacificprivatemoney.com. We're at the 415 here at 415-883-2150.
And Ken, got to give out your
information. Listen, I'll say this real quick. Trivia question. Who's the only money manager on planet Earth that has 5-star rankings on Morningstar in most of the asset allocation categories rated by that firm.
Ken Winans.
You're talking to him. This is it. I beat all the big guys. So as they say in poker, read it and weep.
Yeah.
So, and again, I would just encourage people, go on Morningstar if you use it. Performance says all you need to know. But we also have it on our website, which is winansinvestments.com. Also, if you're interested in my books or my articles, just look up my name on Google. It'll take you to my Forbes articles and Amazon. My financial history books are available there.
Awesome. Guys, it's been a pleasure as always.
Absolutely.
Good job. A lot of great information. And for the audience, we're going to cut out. So here's our thoughts for the day. 2 things define you: your patience when you have nothing, and your attitude when you have everything. That's true, right? And on a little lighter note, why does Djokovic pay with American Express? Because he has no visa. Do you remember, Dennis?
There you go.
Okay. All right.
Humor.
You got to throw one more in there. How did the pharaohs convince people to build their monuments? It was a pyramid scheme. All right. Tune in next week to The Best of Investing. We're going to be giving away more free prizes for answering trivia questions. Thanks for listening. On behalf of our team, I'm Edward Brown, wishing you the best of investing. So long.